Gold just surged past $4,880 per ounce on January 22nd, 2026, and Wall Street's biggest banks are predicting it could soar even higher. We're talking about $5,400 by year end. Let's break down what's happening with gold right now and where the experts think it's headed. As of today, January 22nd, 2026, gold is trading around $4,880 per ounce, hovering near record territory. It hit a fresh all-time high of $4,888 yesterday, January 21st. Gold has surged 75% in just 1 year, from around $2,750 to nearly $4,900. This is one of the most dramatic rallies in gold's history. Despite President Trump withdrawing his European tariff threats and ruling out military force over Greenland, gold remains resilient near these record levels. The safe haven demand is still incredibly strong. Here's what the major financial institutions are predicting for gold in 2026. Goldman Sachs is the most bullish with a target of $5,400 by December 2026. They just raised their forecast from $4,900 to $5,400. That's another 12% gain from current levels. Their reasoning? Central banks diversifying reserves and private investors, hedging policy risks. JP Morgan has a target of $5,050 by Q4 2026, rising to $5,400 by end of 2027. They expect investor and central bank demand averaging 585 tons per quarter, with central banks buying around 900 tons this year alone. Their analysts said the trends driving this rebasing higher in gold prices are not exhausted. Bank of America has a target of $5,000, though they're cautioning that sharp 2025 gains may lead to short-term pullbacks. But their long-term outlook remains bullish. Morgan Stanley is more conservative with a target of $4,400 to $4,500 by mid-2026. They still see 10% upside, citing strong ETF buying and continued central bank purchases. Citi Research has the most aggressive short-term forecast, targeting $5,000 in the next 0 to 3 months. Other forecasts include HSBC at $4,150 by year-end, Deutsche Bank with a base case of $4,150 that could hit $4,950, and Yardeni Research with an ultra-bullish $6,000 target. So why is gold rallying? There are 6 key drivers. First, there's a central bank buying spree. Central banks bought 585 tons in Q3 2025 alone. China, India, and emerging markets are aggressively diversifying away from US dollars. For the first time since 1996, gold represents a larger share of central bank reserves than US treasuries. This is a structural shift, not temporary. Second, geopolitical uncertainty continues with Trump tariff threats, even though he just backed off Europe. Middle East tensions, US-China relations, and political instability driving safe haven demand. Third, the US dollar is weakening. Federal Reserve rate cuts in 2025 weakened the dollar, and lower interest rates make non-yielding gold more attractive. Real yields are dropping or negative. Fourth, inflation concerns persist. Inflation keeps ticking up. December hit 2.9% after November's 2.7%. It's still above the Fed's 2% target, and gold is the classic inflation hedge. Fifth, there are record ETF inflows. Investors poured 310 tons into gold ETFs year to date. JP Morgan expects another 250 tons in 2026. Individual investors can now buy gold at Costco and local retailers. Sixth, there's a loss of confidence in fiat currency. There's growing distrust in traditional currencies. Countries are reducing U.S. Treasury holdings. And China reduced Treasury holdings to a 17-year low. President Trump just backed off his threat to impose tariffs on 8 European countries scheduled for February 1st. He says he's forming the framework of a future deal with NATO over Greenland and the Arctic region. The impact on gold is minimal in the short term, with reduced geopolitical risk causing a slight pullback, but long-term the effect is minimal. The structural drivers remain intact. The bigger picture of uncertainty, debt, and central bank buying continues. Not everyone is bullish, though. Here are the risks. If the Fed stays hawkish and inflation persists with the Fed keeping rates high, gold could struggle. If the dollar strengthens with a surprise dollar rally, it would pressure gold. An economic boom, where strong growth makes stocks more attractive than gold, could hurt prices. Profit-taking is possible. After a 75% rally, investors might cash out. And if central banks stop buying and demand drops, prices could fall. But most analysts think these scenarios are unlikely. The bottom line is this. Gold just had one of its best years in history, up 75% in 12 months. Wall Street's top banks think it's going higher. Consensus is around $5,000 to $5,400 by year-end 2026. The rally is being driven by central banks diversifying reserves, geopolitical uncertainty, inflation concerns, and a weakening dollar. Trump's tariff retreat is just noise. The structural bull market in gold appears intact. Whether you're an investor or just watching the markets, gold is the story to watch in 2026. The question isn't if it hits $5,000, but when